What I am doing right now is not chasing a hot commodity. It is not some dramatic attempt to become an oil cowboy because the headlines got loud. It is much simpler than that. I am buying oil because I do not trust this market to fully appreciate what a real supply shock can do to everything else. And when I say everything else, I mean everything: stocks, inflation, consumer confidence, transportation margins, interest rate expectations, the emotional stability of a market that has spent a long time pretending it can absorb every new risk without paying a meaningful price. That is what I want to talk about, because this is not a normal environment. And if you keep treating it like a normal environment, then one of two things usually happens. Either you dismiss the danger because prices have not yet gone fully vertical, or you become theatrical and start buying random oil exposure without understanding what problem you are actually trying to solve. I do not like either response. I like structure. And right now the structure tells me oil is one of the cleanest hedges against a world in which a real energy shock can still crack the stock market, squeeze the consumer, and force investors to rediscover what supply actually means. Now let me begin with the obvious center of the story, the Strait of Hormuz. You do not have to be an energy analyst to understand why this matters. You only need to understand bottlenecks. The Strait of Hormuz is one of the most critical maritime choke points in the world. Roughly 1/5 of global oil flows through it. That means you are not dealing with some obscure regional inconvenience. You are dealing with a physical bottleneck that sits under the movement of global energy itself. When traffic through a choke point like that becomes disrupted, threatened, mined, delayed, or politically weaponized, markets do not merely react to what is lost today. They react to what might not be available tomorrow. That is the first thing I want you to understand. Oil prices do not wait for the gas station to go dry before they move. Markets are anticipatory. They move when the probability distribution changes. And that is exactly why this moment is so dangerous. If a waterway that handles 1/5 of global oil becomes effectively choked, and if shipping, insurance, military risk, and political signaling all point in the same direction, then you are no longer discussing a routine commodity fluctuation. You are discussing one of the most serious supply disruptions modern markets can face. Now, here is the thing that confuses people. If the situation is so serious, why has oil not already gone to some absurd civilization ending number? That is the wrong question. The better question is this: what is temporarily preventing the full panic? The answer is inventories, buffers, stored barrels, already produced energy that has not yet vanished from the system. That is what often slows the visible violence of a supply shock in the beginning. The market still has something to lean on: commercial storage, strategic reserves, crude already in tanks, crude already floating, refined products already inside downstream channels. That is why the first stage of a real oil shock often looks less dramatic than the structure would suggest. The market is burning the furniture before it admits the house is cold. That is the dynamic. And if you do not understand that, you keep asking the wrong question. You ask, why is oil only at this level? Instead of asking, what buffer is being consumed to stop it from going much higher? That is a very different line of thinking. Inventories are not magic. They are time. And time gets used up. That is what makes this dangerous. Because a buffer can create the illusion of control right up until it starts disappearing fast enough that the illusion breaks. Then price has to do the job the inventory was doing before. That is when things can become vicious. Now let me explain why oil matters so much beyond the oil market itself. People talk about oil as if it were just another trade. It is not. Oil as a transmission mechanism. It moves through everything: fuel, shipping, aviation, trucking, chemicals, plastics, fertilizer, packaging, food, industrial production, consumer goods. When oil spikes, the problem is not confined to energy investors. It leaks into the entire pricing structure of the economy. That is why oil is one of the fastest ways a geopolitical conflict becomes an inflation problem. And once inflation becomes the problem, the stock market starts facing a very different type of pressure. This is what so many investors get wrong. They treat energy shocks like isolated stories. Number, an oil shock can hit equity markets through several channels at once. First, it pressures margins. If energy-intensive companies face higher input costs, those costs either crush margins or get passed on to consumers. Second, it pressures the consumer directly. When households spend more on fuel and energy-related costs, they have less room for everything else. Third, it pressures inflation expectations. And once inflation expectations move, central banks become less comfortable. Less comfortable central banks mean tighter financial conditions for longer. That matters. Because a stock market that has learned to survive on some combination of earnings, I've said it in enthusiasm, by dip culture and future rate cut fantasy, can become much less stable when oil reminds it that the real economy still runs on molecules, not only on software. That is why I am buying oil. Not because I think the rest of my portfolio is trash, The opposite, I actually want to keep owning the rest of my portfolio. I want to stay long productive assets. I want to keep my gold. I want to keep my broader market exposure. I want to stay in the game. What I do not want is to stand naked in front of a supply shock that can hit the very assets I otherwise want to hold. That is the distinction. This is not a purity trade. It is a hedge. And that word matters because a hedge changes the emotional profile of the entire portfolio. If oil continues higher and the rest of the market gets hit, I am not sitting there watching everything bleed with no offsetting force. I have something in the book that is designed to do well in exactly the scenario I fear most. That is useful. That is why grown-up hedging exists. Not because you want disaster, because you want survivability if disaster arrives. Now let me say something else very clearly. I do not think oil has to go to some cinematic number for this trade to work. It does not need to make a new inflation, adjusted all-time high to damage equities. It only needs to rise enough, persist long enough, and keep the inflation and supply conversation ugly enough that the stock market starts repricing the comfort it has been enjoying. That is a lower threshold than many people realize. Still, if the disruption drags on and inventories continue to do the exhausting work of buffering physical tightness, then yes, I think oil can move a great deal higher from here. Not because I enjoy saying that, because the math of demand destruction is cruel. If enough supply is threatened or removed, the price must rise high enough to make somebody consume less. That is the function of a spike. It is not merely to enrich the producers, it is to ration demand. Markets do not politely ask consumers to drive less, fly less, ship less, produce less, and consume less. They use price. That is how the system clears when barrels do not show up where they are needed. And the higher the disruption, the more brutal the rationing price can become. This is also why people keep misreading the current tape. They see oil above $100 and say, well, it is not at 200, so maybe the danger is exaggerated. Number that is not how serious commodity shocks work. The first move is often fear pricing. The next move is buffer usage. The later move, if the shock persists, is physical recognition. And physical recognition is when the market starts pricing not what is theoretically in the world, but what is actually deliverable in time, in place, in usable form. That is a much more violent stage. You can have billions of barrels sitting in some broad inventory category and still have a real shortage problem. Why? Because not all barrels are equally useful, equally located, equally refined, or equally deliverable on the timetable the market suddenly needs. This is one of the most misunderstood things in the entire oil conversation. People love giant aggregate numbers because they feel comforting. They hear a huge inventory figure and imagine a giant warehouse full of rescue, but location matters, refining matters, logistics matter, political control matters, release speed matters. A barrel on paper is not the same thing as a barrel arriving where it is needed fast enough to prevent panic. That is why I say inventories are a buffer, not a solution. And buffers can disappear much faster emotionally than they disappear physically. Once the market believes the buffer is becoming unreliable, price does the rest. Now let me tell you why I am not treating this as a free bet, because there are real risks here. The biggest risk is obvious. De-escalation. If the situation cools enough, shipping normalizes enough, and the market becomes convinced that the worst case supply threat is genuinely moving off the table, oil can retrace sharply. That is exactly the sort of volatility you should expect in a politically driven oil trade. That is why this is not a risk. Free long. Nothing about it is risk-free. If diplomacy gets traction, if shipping risk eases, if inventories prove more resilient than feared, demand weakens before supply tightens enough, any of those things can hit the trade, and you must be adult enough to admit that before you put money to work. But here's the thing. A hedge is not required to be risk-free. A hedge is required to be useful. When the thing you fear actually happens, that is the test. And in that sense, I think oil is extraordinarily useful here, because if the bear case on the stock market is driven by an energy shock, then oil is one of the cleanest ways to own the shock itself instead of just suffering from it. That is why I prefer it to many other forms of generic defense right now. Oil is not merely a risk asset. In this context, it is the source of the pressure. Owning some of the pressure is very different from merely bracing for it. Now let me bring the stock market into this directly, because this is where the emotional logic becomes obvious. Suppose I own the S&P 500. Suppose I own metals. Suppose I own other risk assets I fundamentally still like over the long run, and suppose a prolonged oil shock hits. What happens? My broader portfolio likely takes damage, at least in the short run. Maybe a lot of damage margins get repriced. Inflation risk goes higher, consumer fears rise, policy hopes weaken, valuation multiples compress. That is the ugly path. But if I also own oil, and oil is rising because the very shock I feared is unfolding, then I have something else. I have offset. I have psychological stability. I have a profit source that can either reduce the damage to the overall account or, better yet, become ammunition to buy quality assets later when fear spreads. That is a major difference Because without the hedge, you spend the decline hoping it ends. With the hedge, you spend the decline planning what you will buy with the gains from the thing that was designed to protect you. That is a completely different posture. That is what I mean when I say I am buying oil not only to make money, but to stay aggressive elsewhere without becoming fragile. Now, let me say something even more honest. I would actually prefer for the world to calm down and for the rest of my portfolio to keep rising peacefully. Of course I would. I am not rooting for war. I am not rooting for scarcity. I am not rooting for an oil shock that punishes ordinary people, but the market does not care what I root for. The market cares what is happening. And if I can see a non-trivial chance that an energy shock can become the trigger for a stock market drawdown, then I would rather prepare than moralize. Preparation is not cynicism. Preparation is respect for reality. That is what this trade is for me. Now, let me talk about position sizing, because that is where adults separate from gamblers. If you treat an oil hedge like a heroic all-in conviction bet, you are doing the exact thing I am arguing against. The purpose here is not to convert your entire portfolio into a one-theme speculation. The purpose is to own enough of the hedge that it matters if the shock unfolds without making the rest of your financial life depend on a war lasting longer than it should. That is the correct posture. Enough to matter, not enough to dominate. That is how I think about it. And if the trade works, wonderful. If it works because the rest of the market gets hit, then I can use the gains to buy the dip in the things I wanted to own anyway. That is where the real elegance appears. The hedge becomes future offense. The protection becomes ammunition. The stress event becomes a source of deployment capital. That is the structure I like best, not because it feels clever, because it is robust. Now, there's another reason I like oil in this specific moment. The broader market has grown far too comfortable treating every stress event as another buying opportunity that never fully escapes the gravitational pull of easy optimism. That attitude can persist for a very long time until it cannot. And energy shocks are one of the few things that can break that emotional rhythm quickly, because they translate into something people immediately understand: higher prices, higher fuel costs, more inflation pressure, more economic uncertainty. You do not need a PhD to feel an oil shock. That is why it can change psychology faster than other types of risk. And markets are not just valuation machines, they are psychology machines. It matters because a market that thinks it can shrug off anything often needs only one category of risk that it cannot easily financialize into a happy story. Oil is very good at refusing to be turned into a happy story. Now let me bring this all the way down to the cleanest conclusion I can give you. What is happening around the Strait of Hormuz is not normal. It is a serious threat to one of the most important oil arteries on Earth. 1/5 of global oil flows through that choke point, and recent events have been severe enough to drive oil above $100 and to force the world into emergency diplomacy, military escort efforts, and constant repricing of shipping risk. Inventories are helping. That is true. But inventories are a wasting defense, not a permanent cure. If the disruption persists, the market may eventually have to replace the comfort of buffers with the brutality of much higher prices. That is the danger. And because oil shocks do not stay inside the oil patch, they can hurt stocks, consumers' margins, inflation, and policy expectations all at once. That is why I am invested, not because I suddenly became an oil evangelist, because I want to hedge against the kind of shock that can break the cheerful assumptions buried inside the rest of the market. And if that shock arrives, I do not want to be the person staring at a red portfolio asking what happened. I want to be the person who prepared early enough that the crisis created buying power instead of only pain. There is also a practical reason I prefer a hedge like this to simply raising more cash. Cash protects nominally, oil protects specifically. Those are not the same thing. If I sell productive assets, I still want to own simply because I fear a drawdown. I create a different problem. I lose my place. I owe taxes in some cases. I may fail to get back in. I may spend months or years waiting for the perfect reentry while the market recovers without me. That is a very common form of self-inflicted damage. A targeted hedge lets me avoid some of that. I do not have to liquidate conviction. I can keep the long book I believe in and still own something that responds positively to the exact macro pressure most likely to hurt it. That is far more efficient. It is one of the few times where owning two things that would normally seem unrelated suddenly makes deep strategic sense. One is the future you still want. The other is the force that could temporarily crush it. That is how I think about oil here, not as a replacement for my long-term portfolio, as insurance on the path. And insurance is one of those things people love to mock right up until they need it. Now let me talk about why this is psychologically easier for me than trying to short the market directly. Shorting broad equities requires you to be right not only about the direction, but often about the timing and the speed. It is a much less forgiving expression of fear. Oil in this context is cleaner. If the bearish outcome for stocks arrives because an energy shock worsens, then the commodity itself may express the danger more directly than a generic index short. That is what makes it attractive. I am not betting that every company in America is suddenly worthless. I am betting that if an oil shock intensifies, Oil itself should know it first and reflect it hardest. That is a more coherent structure, and coherence matters. Now, another thing I want you to understand is that this is not only about crude price charts. It is about second-order behavior. What do refiners do? What do airlines do? What do chemical producers do? What do trucking margins do? What do consumers do when gasoline spikes? What do politicians do when consumers get angry about gasoline? What do central banks do when an external shock starts bleeding into inflation expectations? This is why a real oil move matters so much more than many people realize. It changes behavior everywhere else. And because it changes behavior everywhere else, it changes valuation. That is why I resist the lazy framing that says oil up, energy stocks happy, end of story. Number oil up can mean the cost of resilience rises for the whole system. And when the cost of resilience rises, the market eventually has to choose what gets repriced. Sometimes that takes weeks, sometimes months, but it almost never means nothing. There is one more subtlety here that I think matters. Markets have gotten very used to demand-side scares, growth scare, recession scare, rate scare, bank scare, those all matter. But supply shocks are different. A supply shock does not politely wait for confidence to return. It pushes against the real economy from the outside. It creates the kind of problem that cannot be solved by optimism alone. That is why supply shocks feel so destabilizing. They are harder to narrate away. The market can talk itself through a lot of things. A hard physical shortage is not one of them. That is why I am paying so much attention to the language around rerouting, escort operations, insurance withdrawal, and buffer drawdowns. These are not cosmetic details. They are the plumbing of global supply, and finance always looks smartest right before it is forced to remember that plumbing still rules. Now let me tell you what would make me back away from this thesis. I like to know the invalidation case before I know the victory lap. If genuine de-escalation takes hold and shipping starts moving in a way the market can trust. If insurance normalizes enough that traders stop pricing extreme passage risk. If inventories stabilize instead of eroding. If demand weakens materially before supply tightens enough to matter. If diplomacy stops being headline theater and turns into operational normalization. Those are the things that would make me less interested, because then the hedge would be doing less of a job I actually need done. That is important. I am not married to oil. I am married to the logic of protecting the portfolio against the specific kind of break I think is plausible. If the break becomes less plausible, then the position deserves less devotion. That is how serious positioning works. It follows the function, not the identity. And that is another place people go wrong. They fall in love with the instrument. I am not in love with the instrument. I am in love with the usefulness of the instrument. Those are not the same thing. Finally, let me say something about courage. A lot of people think courage in markets means maximum aggression. I do not. I think real courage often looks like admitting where you are vulnerable and paying to reduce that vulnerability before everyone else can see it clearly. That is what this is for me. An admission that the rest of my portfolio, no matter how much I like it, is still vulnerable to a category of shock the market has not fully respected. And if I am right, then I will be grateful I paid for that honesty early. If I am wrong, then I will have lost some money on protection I may not have needed. That is a tolerable mistake. Being unhedged into the exact scenario you were worried about is a much more expensive one. That is the difference. Not prophecy, preparation. And in a market like this, preparation is often the only form of peace of mind worth paying for.